Really pleased to introduce Aditi Kothari, our founder member, and also someone who's been spearheading the initiative in really helping women to understand why it's critical to be financially empowered. Today, we're discussing asset allocation. I'm going to hand over to Aditi to set the tone for the conversation. Aditi, over to you.
Hi, Abha, and thank you so much for inviting me always to be part of sessions like these. And I really do hope that everyone learns as they hear. But let me just dive right into this. So let me start. You all know a little bit about Winvestor. I've done a session before. It's an initiative from DSP Investment Managers, or DSP Mutual Fund, as most people know, to help women to get more confident about investing, to help them learn a little about investing, and really to encourage them to take charge of their own money, which is very important. A few concepts. So, everyone thinks investing is for a man, but actually women have more patience, and investment needs patience. And frankly, therefore, invest like a woman. Don't think that you are going to be any less than a man when you're investing. The question then comes to, where to invest, how to invest. And, I've done a much longer seminar, and this is going to be really short. But really, everyone asked me, where should I invest? My one friend is putting it in this fund. Should I just put it in that fund? Or someone has told me, this one stock is going to go up. Should I just go behind that and put it in that one stock? What should I do? And a lot of times, in Hindi, they say, people come to you and say, Are, isme laga do, bas laga do. And I'm here to tell you, you cannot do that. So the first thing to realize when you're investing is, what are your goals? Why are you investing? So write them down. It could be, I'm investing to buy a house, I'm investing to buy a car, I'm investing for another vacation. Put that down and we'll put those to a side. Okay. The rest of it usually is going to be, I don't know why I'm investing. I'm investing for a rainy day. I'm investing just to build my wealth. I'm investing for security. I'm investing for my next generation. I just want my money to grow. That's also okay. That's the overarching goal that we have. As long as you figure a few things out, your financial advisor, and that's one thing you must do, is get your financial advisor. Explain this to them. I am here to tell you what questions you should ask your financial advisor and how he should be doing things for you, and you can a little bit guide him. But eventually, you need to tell them your goals on why you're doing it, so that he knows that if in 2 years you want to buy a house, or in 6 years, you want to buy a house, or in 2 years you want to buy a car, he will manage your money in that way because he knows a big expense is coming up. What you don't want to do is invest everything into the markets. Market goes down and your house goes with it. You don't want that. So there's some money you can take risk in and some money you can't. So the first thing we need to do is learn about ourselves. This comes in something called risk profiling. Now, risk profiling will first ask you, and usually these are questionnaires, and you have to tell your financial advisor, I'm not buying anything till you do my risk profile, because you want to understand who you are and they need to understand you very well. So the first thing the risk profiling questionnaires, and these are basic questions that you can find on various websites. You can even just type this in. DSP will have one very soon as well. And it'll ask you, this risk profile will ask you your risk tolerance. Or rather, first they'll ask you your risk capacity. Your risk capacity is according to your age, according to your income, according to the number of dependents you have, according to your future potential of income. So I'll give you an example. If you're 25 years old, you're probably going to live till 70, 80. It's okay if the market goes down a few times, goes up. On average, the market has always gone up. You always want to buy in companies that are going to last, and let the mutual fund manager or an index fund, we can talk about those later, do that work for you. Market on average goes up. So at 25, you can afford to take some risk. So your risk taking capacity is high. If you have no dependents, then you have no responsibilities. Usually that happens when you're young. Again, your risk-taking capacity is high. If you're earning good money or have studied well, then you're potentially going to have good money in the future. So your risk-taking capacity is high. So that's called risk-taking capacity. Okay, that's very objective. Now your risk-taking tolerance, okay, which we see here, bottom left, that now is very dependent on your psychological makeup. There'll be some people who say, I don't really mind if the markets go down 20-30%. Rene, though, I am invested for 20-30 years. I don't mind. Or this is going to go to my kids and I don't mind because this is going to be an everlasting investment, and let it go up and down. I know in the long run it will go up. It's fine. There's some people who say, no, I can't stand I'll get very anxious if the market goes down 10%. I know the market will go up and down, but I can't deal with it going down even 10%. I can't bear to see my money down 10%, even if I know it's temporary. All downturns usually are temporary when it comes to the market and you diversify your portfolio, which we'll talk about. So they said, no. So then you have to give them something very different. So then you have to invest in something very different. So the guy who's like, okay, I don't care if it goes down 20-30%, and the person who says, I can't even deal if it goes down 10%. They have two different kinds of risk tolerance. So now let's combine risk capacity and risk tolerance. Here is someone on the left-hand side, someone's sample risk profile. Their risk capacity is high because their age must be young, they have high annual income, they have good job security, okay, don't really have any dependents, but their emotional stability is on the red, which they probably say, I don't really want to lose money. But at this point, what do? You still need a required risk to attain your goals and to make some money. So you can't, if you have high risk, capacity and low risk tolerance, I'm not going to put you low on the risk profile. You'll be somewhere in the middle. And middle people, if you look on the right-hand side, would be probably suggested 30% in equity, 30% in debt, some in real estate and gold, and some in cash. This is very arbitrary. This is not, sacrosanct for everyone, and it depends on the time. But I'm just saying that that person should not be given 100% equity because that's very volatile, but that person should not be given zero equity either. The person has to take a little risk because the capacity is allowing that. So that is called risk profiling. So my risk capacity and my risk tolerance will be very different from Abha's. So what could work for Abha may not work for me. What works for your friend may not work for you. What works for your parents also may not work for you because your risk tolerances may be different. So please remember that you have to decide who you are and what your risk tolerance is and your risk capacity is, and then you have someone make a profile for you or your asset allocation for you. I hope this is clear, and I'm happy to take any questions on this later. Let's go to the previous thing we talked about. There's equity, debt, real estate, cash. Like, what is all this? What is this? Today, when you think of equity, Abha, what do you think of when you think of equity today?
Stocks.
Exactly. So today people think of stocks in stock market. Which stock should I buy? HDFC Bank or HDFC or ICICI? What should I do? Okay, but that is what was done maybe 20-30 years ago when there wasn't something like equity mutual funds where you have a fund manager deciding all that for you. You don't have to worry about it. Let them make the calls and let them buy a basket of equity stocks for you so that you don't have to bother with the selection. So that's more of the new age, last 15-20 years, that's become more prominent. And now you have something called ETFs, which is just simply, index funds, which just buy the market. By the market, I mean, they just keep buying the 30 top, if you do BSE, it's just 30 top stocks by market cap. The 30 largest companies that index will have, Nifty 50, which is another index, just buys the top 50 companies, no matter if they're good, bad, high debt, low debt, nothing. They just blindly buy the 50 and you just buy the index, and that's what's called an index fund. Okay. So, but at least you're getting diversification there. Now, if I say fixed deposit and fixed income, what comes to mind for most people? Bonds, maybe government securities, government bonds, fixed deposits. I mean, that is really what essentially comes to your mind. But guess what? There is something called debt mutual funds. Debt mutual funds give you what is called liquidity, means when you want to go and withdraw, you can get your money back. Versus FDs, you have to stick on for as long as the FD is stipulated for. Similarly, there are tax differences, which we'll discuss later. So that's what a debt mutual fund. Again, there are debt fund indices, not that prevalent, but they have some. Then in cash, when you just have cash, what do? You put it in a bank. Hopefully, you all don't just keep the cash. When you're putting it in the bank, there is something called even a liquid mutual fund, which sometimes can give you a little more return than savings funds. So then a savings account. So we have to look into those also. Especially if you're looking to eventually invest into equity funds. Liquid funds are great because you leave it in there and you can quickly move it to equity funds. And then there is, people think of alternative investments, or what else is there, right? What are the physical investments that we have? We all feel the investments, right? Gold, jewelry, real estate, great. But today, people have gold ETFs because you can't. If you want to buy gold because the gold price is down, what are you going to do? Run buy some jewelry, okay? And then you want to sell it again because the price is really high. Can you do that? You'll get attached to it. You have to store it. You may not immediately find a buyer for it. You have to physically take it somewhere. Much better to buy gold ETFs. And same with real estate today. You guys are buying, people buy houses, but buy houses to live in, no problem. But if you're planning to buy a house to, just rent it, buy what is called a REIT. They buy the house, they rent it out, and you buy a share of it, and you keep getting your rental income, so that is a more sophisticated instrument today that is available. I, of course, am from the world of mutual funds, so I certainly believe in them, and all my money, I would say most of my money is in mutual funds. And so I know best about them. So sometimes people ask me, but why not real estate? Why not gold? I'm not saying don't buy anything. Buy a house wherever you all want, for fun, for leisure, to stay. But when you all are thinking of buying a house for rental, and you think that that is actually going to give you, that is your investment and the rental income is going to be good enough for you, well, please do compare it to a mutual fund at that point. And what are some of the negatives about real estate? The illiquid. Tomorrow, when you really need the money, you can't go and sell your house. It doesn't happen so quickly, so we call it illiquid, which means you can't make it liquid. You can't just go and sell it and get the cash back that easily. When you try to buy real estate, we all get nervous and trepidatious with the transparency. It's not like, it's not as clean and clear as doing buying a mutual fund, right? The taxation, when you're going to get your interest, or rather your rental income, you pay full tax on it. The same tax that you would pay in income tax. And especially if yours is a higher tax bracket, that's a problem. And there are always some legal issues with your tenants, the legal, you need lawyers, it's a headache. You can't diversify. Can I buy 20 houses? No, I can't. So if that area, something happens, then all your money is invested in one thing. So you're again not allocating. Chances of fraud, we've all gone through. Cost of transactions, you're paying the broker to buy it. You're paying the broker when you're renting it. Then you're paying the broker when you're selling it. Do you all take that into consideration? What about the maintenance? You have to maintain the house. I mean, those are costs again. And then, of course, the idiosyncratic list. What if a flyover comes in front of your house, or if another building comes and blocks your view? Things like that. So we don't realize all this when we buy real estate. We think it's the safest, but there are a lot of issues. And because every day the price of your house is not listed on an open stock exchange, you think it's not, risky. But then, you can buy a basket of mutual funds and forget about them. Don't think that they're listed only. So that's the same thing. Same thing in gold. On average, gold in the last 15 years has done very well. If you really look at it long term, gold has not given the best returns. And of course, you want to buy physical gold, great. Where are you going to store it all? What about the taxation in that? It's a little better than real estate, but you still have to pay tax. What about the impurity? Can you trust someone? Anyone that you buy gold, if they tell you it's 24 carats, are you going to go check it all the time? What if you go to sell it and you realize it's there are impurities in there? Theft. We're so scared of our gold. We go and make sure 20 times our safe is locked. And then no regular cash flows. You can't even rent it out like you would in the real estate world. So just remember that, even physical assets, please have some for pleasure. But just know for investments, there are some, there are some limitations that we should all be aware of. So what kinds of mutual funds people tell me, right? They ask me many times. So if you want low risk, I don't want any risk. I don't want the market should not fluctuate. But low risk will always give you low return. And we have something for you. It's called a liquid fund. Don't expect crazy kind of returns in that. You have measured returns. Right now, they're giving 3-4% because that's what the interest rates are. And their price doesn't move that much. So low risk, low return. The way we define risk in finance is how much does the stock price or the NAV, as we call it in a mutual fund, which is the same as the price of a mutual fund, how much does it go up and down, up and down? How volatile is it? Well, liquid funds are up, it doesn't go up and down that much. Whereas specialty focused equity funds, like if I want to buy just something on, just a fund focused on energy stocks, just a fund focused on technology stocks, that is going to go up and a lot because you're only focused on one sector. If something happens, like the healthcare sector, the FDA, which is the American authority where most pharma companies were exporting their medicines, they came down and said, we don't like the plants, and here's all the changes you need to make to your plants before you can export back to the US. So they all went through a big hit in their revenues and a big hit in their stock prices, and it all happened all together. So much bigger risk when you're on focused funds. Okay, so you can go up higher the risk you take, the higher the return. However, when people did finally invest in healthcare funds, we had started one in 2018. They've done amazingly well because then, they fixed all their issues. And of course, COVID happened. And suddenly their revenues went up a lot and the whole basket of stocks went up and, people made a good amount of money. So you took the risk, you got the return. So there is nothing in this world where you don't take the risk and yet get the return. So please, let's get that out of our mind. And if someone ever tells you that I'm giving you something with high return, no risk, don't believe them because that's not true. It's like someone telling you that I'll help you float. There's nothing called the law of gravity. So why do you invest for the long term, right? We always say invest for the long term, but why? Something is called compounding. Now, compounding, whoever's really good in maths, is your principal multiplied by 1 plus the returns as a percentage. So if it's 9%, it will be P, 100, and P is say, 1 lakh multiplied by 1 plus 0.09, which is 9%, raised to how many ever years. The longer you stay, this equation will obviously get bigger and bigger. Of course, if your returns are higher, it will also go up. If your, the original amount you invest is high, your total will also be high. But time is exponential. See, it's raised to that, which means your interest is. So when I go and I have 100 rupees and I have a 10% interest at the end of 1 year, it's 110. Then I make 10% on that, which is 11 rupees. Then I make 10% again on it. And then I make 10% on, so you're making interest on your interest. And that is called compounding, because over time it becomes so large, you don't even realize it. But you have to keep it invested. The longer you keep it invested, the better your returns will be. Your overall pie, again, you can't keep it in one stock. You're going to keep it in one stock, that stock can even go bankrupt. You have to keep it in a basket of securities that change over time if they need to. But don't look at your portfolio. When you say that this is for the long run, this is for my children, this is for my next generation, please don't look at your portfolio. Invest it and let compounding do the magic. So understanding volatility through diversification and diversification. So we've given you an example here on why you need so many stocks in your portfolio. We've only given 2 stocks here, very hypothetical, and these are international stocks. So we've given something that people understand, Nike and Starbucks. So if you only had, so the yellow is Starbucks, the blue is Nike, and the green is your portfolio. See, on blue, Nike fell so much in 2002, but Starbucks went up a bit. So your portfolio fell, but not too much. In 2003, they both went up and your portfolio also went up. Same with 2004. If you had just put in Nike, it didn't go up that much. But because of Starbucks, your portfolio really did go up. And look at 2007. Like this, Nike is the problem. Nike is not the problem. Starbucks went down in 2007, but Nike was up. So your portfolio didn't get affected that much. So, the whole idea is you need a basket of stocks to really help you, because I don't know what Nike is going to do tomorrow and I don't know what Starbucks is going to do tomorrow. And this is just 2 stocks. Most fund managers will have, of course, many more than 2 stocks. You get anywhere from what is called a concentrated portfolio, is like 10 stocks, 12 stocks, all the way up to something really diversified as 50, 60 stocks. Now, you don't want like too many stocks also, because then it really doesn't make sense. If one is always going to offset the other, you'll never make anything very substantial. So just remember, at the end of the day, you want a portfolio, if you want to take more risk and something much more concentrated, 12, 14 stocks. Want something much more diversified, 50 stocks, 60 stocks, max. That would be a good portfolio for you. But let a fund manager or an experienced professional put that basket together for you. And again, your portfolio can't just have stocks. You need some fixed income, debt, mutual funds that are less risky. Remember, we saw this. You need some of the purple, you need some of the blue, you need some of the red, you need some of the green, you need a bit of everything depending on your risk tolerance and your risk capacity. The percentages will vary. Lastly, tax in India. If you keep your money for over 1 year, the first lakh is tax-free. After that, you pay 10%. If you withdraw before 1 year in equity mutual funds or any equities, you pay 15% tax. Still better than a lot of the income slabs that are out there. If you're on fixed income and you keep your money for over 3 years, you pay only 20% tax, but that's after what is called indexation. What is indexation? Indexation is something that, say today I make 8% and inflation is 6%. Actually, I've only really made 2%, right? So you'll only get taxed on that 2%. But that can only happen if you hold your investments for 3 years in debt. If you take it out before 3 years, it will be taxed just the way your FDs are taxed, which is on your own income tax bracket, which is 30%, 40%, whatever it is, whatever your tax bracket is. So I think with that is what I wanted to say about diversification and asset allocation, and just a few concepts to learn. And I'm sure we'll discuss many more the next time. But if there are any questions that came before or during or after, I'm really happy to take them up.
Absolutely. So lots to discuss. Firstly, that was such an informative chat, Aditi. I think you've so patiently described all the various forms of asset choices that are out there. I have a question for you in terms of, why it's important for women to invest separately from their partners or husbands. Because you mentioned earlier in the conversation, don't think you're any less than a man when investing. And, a lot of women tend to rely on, the men in their family to kind of validate their choices when it comes to investing. Why is there an advantage if we choose to kind of empower ourselves with knowledge, with investing separately, and not put everything into a pool?
Great question, Abhay. But before that, I also want to talk to the audience on why women need to invest. Why should they even bother? Okay, one is most women are working today. So it's your money, you've made it. Otherwise, you will inherit some money. Parents don't give it now just to the eldest son in the family. So whatever little money, you will inherit something. You may inherit from your husband, you'll inherit probably from your parents. There will be some money in your name eventually. Okay. Third thing, unfortunately, mishaps happen, right? And early demise of a partner, divorce rates that are increasing. All of those reasons should make you think on why you need to take charge. Firstly, it's your money, you should be accountable, you should take charge. And then on top of that, something bad happens, and you just, oh my God, now what do I do? So let's be confident beforehand. And sometimes if you're a working woman and you want to take some time out to have a child and you're used to earning money, well, you should never hesitate. Please go take that time off, have your child, take as much leave as you want, even if it's after your maternity leave. And let your money work for you that you have saved. So you should have passive income at that time. If you're not used to asking your husband for money to buy, some dress you saw at Zara, why should you have to ask him now? Because you're going to have passive income. So it's very important that financial independence feeling is what will give you confidence in the long run. And by investing your own money and taking charge, you'll feel truly financially independent. And the last reason, you want to just splurge. You want to invest, and you want to buy some jewelry. You don't have to answer to anyone. You don't have to ask any questions. You invest it properly, make that your goal, 5, 6, 10 years, and make sure you get what you want. So, those are the reasons. Now, back to the question, should men and women have their separate accounts? Yes, I really do think so. You must have separate accounts. You should know where your money is going, have a separate account, have your own financial advisor. So you should have your own talks with a financial advisor. Okay. No one is saying hide anything from your husband. Discuss it with your husband, see what he's doing, and then make your own decision. You should be accountable yourself. Tomorrow, if something happens and it's your money and your spouse did something that you didn't agree with, you don't want that to be the reason there is anything wrong in your marriage. So take full charge if it's your money, your decision.
Okay. All right. So you should take charge, and that'll, that's something that will help you achieve several things, as Aditi has just outlined as well. You spoke about, various kinds of assets and options of investing, Aditi. And we have a lot of questions coming in terms of, really how to make that choice of where to start. Investors today are wondering, or women investors who traditionally may have put their money in gold are today looking at the kind of returns people are making on stock markets and wondering whether to get in. Now, you spoke about risk profiling earlier, and I think that's really important. But if you had to sort of give them a simple 1 or 2 line answer, do they dive into the stock market? Is that the best option today? How do they kind of navigate, where to first start investing?
Guys, girls, as I said, you have to just find ask yourself, who am I? Am I okay to take risks? Because the market's pretty high today. If it goes down tomorrow, are you okay to lose 20% just to know that you'll make it up in a few years? Or are you going to be nervous about it? So that's again in your risk tolerance. I would suggest if you should do a risk profiling. That's where you start. And then accordingly, you get a risk, you get an asset allocation, which will have a little debt equity. Now, if the market goes up 20%, don't expect your portfolio also to go up like that, because you'll have a mix of everything, debt and equity. But if the market falls 20%, we have to make sure that your portfolio doesn't fall as much. That is what's going to be very important in asset allocation. So where and what you should do first is do your risk profile. If you don't want to do that, or you can't do that, and you really just this second want to do something, I would say dynamic asset allocation funds are good funds. DSP has one, others have, and ours is actually quite conservative. So if you've done nothing and you want to go straight into equities, that's quite a jump. Go in a middle path. It's what's called dynamic asset allocation funds, where they asset allocate for you. When the market is down, they buy more equity. When the market is up, they buy more fixed income, so that if it goes down, you are protected. So this is, it's called a dynamic asset allocation fund. The other one is if you want to take just a little more risk than that, what we call now equity and bond funds. They have a bit of equity and a bit of bond, but since they have more equity than bond, always you get the taxation benefit. So, those I would say are two things which would be for the first time investor who wants to dabble.
Okay. Are fixed deposits completely out of fashion, Aditi? Or I shouldn't say out of fashion, as the feasible investment option, are they much lower down the ladder today?
I mean, they're feasible, but my point is, yeah, are they out of fashion? But they're out of fashion for me, and they should be out of fashion for everyone, I think, because I think it's a real old sort of instrument. You can't get your money when you want it. You feel so lost. You feel so tied up. You can get, similar returns. I can't tell you it's the same, more or less, because, they're market linked returns on a debt mutual fund. And you can get your money whenever you want. So why wouldn't you do that? And if you keep it for 3 years, even if you keep an FD for 3 years, you're not getting any tax benefit, but this you are.
Okay. And why are debt mutual funds becoming more and more popular today, even versus equity mutual funds?
For these reasons, that A, if you keep it 3 years, you're getting a tax benefit, and 2, because you can get your money whenever you want. You're not locked in.
Got it. Is international exposure important?
Yes.
Why is that?
So the government of India allows 2 things. Earlier on few years ago, Indian government never allowed us to invest outside the countries. There were a lot of restrictions with foreign exchange. But then the Indian government in 2004 allowed what is called LRS, Liberal Remittance Scheme, which means every year you can take up to $250,000 out of the country. Within that 250, you can spend money, you can go on vacations, or you can invest it. And so, you can open a bank account abroad. It's not an easy process. You have to be there, you have to do the paperwork, and, but it's a good way to diversify your money. Now, if you find that cumbersome, another way to do it is there are mutual funds in India that then put money into international funds. So DSP has one called the DSP US Equity Fund. We put money into US stocks. And similarly, we have one just for agriculture stocks, which are international stocks. And we have for energy funds. And so, you can invest into funds that invest abroad. And you must, because that's another way to diversify, right? So I showed you all the diversification of different stocks, different asset allocation. But what if something happens to the country? You have to put your money everywhere else. I'm not saying anything's going to happen to India. We all know it's going to grow really well. Very confident of that. But say your child is also going to study abroad. You should, and you have to pay in dollars eventually. So why not put money in international funds depicted in dollars, so that the dollar depreciation doesn't hurt you that much, and you get an appreciation because that market is going up. Now, every year the dollar is not going to depreciate, but over the long run, the dollar has depreciated.
Okay, amazing. I think we've covered a lot of ground today, Aditi. I always love listening to you. I find that you explain some of these concepts in a way that's easy for all of us to digest and hopefully apply to our financial decisions. And if any of you have any questions or want to, speak with this team on, taking forward some of the questions, they're always there to help or guide you. So thanks for tuning in. And Aditi, thank you so much for your time.
Just one last thing. I just want to tell everyone where to start your investment journey. Like if you want to start learning about how to even learn about it.
Yes.
Go to www.dspim.com/learn. It's our learn site. I personally helped to put that up. You can say you're a beginner, you can say you're intermediate, you can say you're advanced, and you'll have modules to really help you start and build to being an advanced investor. Go ahead, do that. Once you do that, you'll be more confident to ask your advisor the right questions.
So absolutely. Education, self-awareness, research, that's really where you begin. Aditi, thanks so much yet again for spending time on your weekend with us. We really appreciate it and look forward to seeing you again soon.
Sure, happy to do many of these. Thanks.
Awesome.
Bye.
Bye. It went really well, by the way. Thank you.
Oh, great. Oh, I forgot this thing. Forgot this slide. Okay.
SIP. We'll pick it up next time. Don't worry.
Yeah. Oh, because you had told me they're asking whether to do the total or you want to do another question on that and just add it to your thing?
We can. Yeah. Okay. Aditi, what about investing a lump sum all at once versus maybe doing it gradually? Because sometimes a new investor wants to get in, or as you said, you inherit a sum of money and there's this tendency to want to just put it all into one asset.
So there are many ways to do this. You can do what is called a lump sum is one time. Or you can do it through a systematic investment plan. So you just put little by little by little. That means if the market goes down, if you're really scared when the market is up. So when you do a systematic investment plan, the market is really raging and it's really high. And you're like, oh my God, it's going to fall. What should I put it in now? What if I fall, I'll be able to get a better price later on. But you never know if it's going to fall or not. So keep putting little by little by little. So if it falls tomorrow, and you're still by little putting it, because it becomes like, a discipline to just put it in the market. And it automatically goes from your account, which is called a systematic investment plan. Then you'll even buy on the lows. And eventually you will average out the cost that you came into the market. One thing is if you're doing a systematic investment plan, which is putting in to the market every month or every week or every quarter, after talking to your advisor, please don't stop it and panic when the market goes down, because that's the best time for systematic investment plans. And in fact, I'll share a little video with Abha later on, which is, the love story between the down market and systematic investment plans. They love each other. So we should never separate them at that point. Where if you still insist and you want to put everything at once in the market is very, very low. Chances are your risk appetite and your anxiety won't allow you to put it. Like last March, when everything was going haywire, who actually put lump sum money into the market? People got nervous and scared. But if you think you really want to do it only when the market is down, or that is in the equity markets. If it's in fixed income, you can do it. The other place you can do it is in dynamic asset allocation funds, which are funds that will on their own put money in equity and debt when the market is up and down, and they will take care of it for you. So don't worry, put it in the dynamic asset allocation fund, lump sum, if you must. At this point, I would tell everyone, please only do an SIP or do lump sum in dynamic asset allocation fund. At this point, as we talk, which is September 2021. And STP means I'm dying. I really don't want it to sit in the bank. Let it go to a liquid fund, which is again very low volatility. And that fund will in turn put money in another fund of your choice. And it'll do it as you tell them, systematically, every month, every week, whatever you'd like. And then if you want to withdraw your money, say you want to withdraw your money, first ask yourself why you should be withdrawing your money. If it's to buy something, I agree. But are you going to pay them all at once? Then take it out, only in chunks. And if you know that you're going to have expenses every month, then do an SWP, which is systematic withdrawal plan. Every month it will keep giving you X amount of money. There's something called instant redemption up to 50,000 rupees. If you have an app, some mutual funds offer it, DSP does. You put the money in a liquid fund, and when you want it, you just click instant redemption, and in less than 30 seconds, it's in your bank, and then you can go and spend it however you want. That's really the different ways that you can make investments into mutual funds and get it out of mutual funds.
Amazing. Thank you. Thank you very, very much.